Welcome to our first tax planning variable video on entity. With the recent changes in the tax law, this choice is more important than ever. Let's start with a story about a married couple, Pam and Jim. They would like to open a pizza parlor. Jim thinks that due to the new corporate tax rate cut, a corporation is a must. Pam thinks that operating as a partnership makes more sense. The pizza joint is expected to make $10,000 in year one, and Pam and Jim want those earnings to be distributed to them. You can see that the choice of entity makes a difference. Corporate entities pay tax at the entity level, and then the income is taxed again at the shareholder level. Pass-through or flow-through entities like a partnership are not taxed at the entity level, but the income does flow through to the individual. After 2017, pass-through entities are eligible for a deduction called the Qualified Business Income Deduction of 20% of the pass-through income. This was in part to lower the tax rate on pass-through businesses to provide parity with the corporate tax rate cut. All right, let's make a minor change to our previous assumptions. So now Pam and Jim want to conquer the pizza world and are going to roll all the earnings back into the pizza shop so that it can expand and grow. Now the corporate tax is the only layer of tax because the earnings are not going to be distributed to Pam and Jim. However, for the flow-through entity, the income flows through whether or not the cash does. As a result, Pam and Jim are going to have to come up with about $2,000 to pay the taxes on the partnership earnings. Corporations provide some opportunity for the buildup of earnings inside the entity that a pass-through may not. One way Jim and Pam could remedy this situation would be to distribute just enough cash to themselves to pay the taxes. This is a common feature of partnerships. Recall our example involving my sister, the dentist, from Module 1. She shifts income from her business or herself to her daughter. This is an entity shift as well. It's just between people, not companies. Income shifting between entities is designed to take advantage of differing tax rates by shifting income to low tax rate taxpayers and deductions to high tax rate taxpayers. Transactions between family members are a convenient and common way of achieving this. But shifting is not just for people. It's for other entities as well. If an individual has a 37% tax rate, the highest marginal tax rate in 2018, they might consider shifting income to a corporation instead. For example, take a quick look at Pam and Jim under our first example, except let's take their individual tax rate up to 37%. Suddenly, the pass-through entity becomes less advantageous, even after the double taxation of corporate income. Okay, let's start with a corporation for which you are the sole shareholder. Your corporation generates $100,000 in revenues and has $60,000 of deductible expenses, leaving taxable income of $40,000. The corporation pays tax at 21% of $8,400. That leaves $31,600 to distribute to you, the owner. You accept the $31,600 and pay dividend tax of 15%. That's $4,740, leaving you with after-tax cash flows of $26,860. You could also say that is the $40,000 less the $8,400 of corporate taxes and less the $4,740 of individual taxes. That's the same $26,860. However, let's say that in order to avoid double taxation at the corporate level, you personally own the building the corporation uses, and thus it's going to pay you rent of $30,000. Now the corporate income is only $10,000, and corporate taxes are reduced to $2,100. The dividend you receive is $7,900, plus your rental income of $30,000. You pay tax of 15% on the dividend and 28% on the rental income, And now your after-tax cash flow increases to $28,315. By the way, you're likely to receive the aforementioned 20% qualified business income deduction on the rental income, but that only makes the difference bigger. By shifting income out of the corporation and avoiding 2 levels of tax, your cash flow increases. Congress is aware of income shifting and has been active. For example, there is something known as the Kiddie Tax that applies to unearned income of children and requires the income to be taxed as at the extremely progressive trust tax rates. It used to be at the parents' rate. Income shifting is nearly as old as the income tax. One of the most important Supreme Court cases, Lucas v. Earl, dealt with income shifting between spouses and dates back to 1930. The assignment of income doctrine has developed from these court cases, which requires that the entity that provides the service earns the income. As an example of the assignment of income, Richie gives his quarterly dividend to Rory in hopes of shifting the income to Rory. Under the assignment of income doctrine, Richie would need to give Rory the stock that pays the dividend in order to complete the assignment. As Lucas v. Earl states, the fruit belongs to the tree that bore it. Okay, so that brings us to the end of this video. We're finally starting to unpack a little bit of tax law. Hopefully you're finding this interesting. I know I love it.